Hello and welcome to Money Roundup. This week we'll be talking about Italy and what economic data really means in the UK.
In the recent Italian elections, no single party had sufficient votes to form a government. However, since the election, Italy's two emboldened populist parties, the Five Star Movement and far-right the League, have been locked in discussions trying to form a coalition government. A coalition has been agreed and Italy is now the first significant EU member state with an anti-Euro movement at the heart of the government.
Understandably, this partnership is ringing alarm bells in Brussels, with the coalition looking to return Italy to a pre-Euro setting, reversing agreements made in the Maastricht Treaty and adopting policies that could potentially reintroduce the lira.
Each new challenge to the status quo in Europe chips away at its fabric. The current challenges may convey some advantage for the UK. With Italian discontent in the background, the EU could find itself on the back foot and more desperate than they portray to avoid the UK crashing out of the Europe without a deal.
With so much data accumulation going on day to day, standing back from the noise looking for key signals is never an easy task. There are always numerous data points to examine. Market participants also factor in their expectations ahead of news to be released. This makes matters topsy-turvy. Good news can turn out to be not as good as expected, and vice versa.
So, standing back, where are we now? Well, noise levels are highly elevated around domestic and geopolitical matters. Chatter about slowing global growth has grown, accompanied by reams of data which point this way and that way. There is also discontent, mainly through the traditional media and the lacklustre performance of the UK economy.
In terms of interest rates, inflation levels and labour market data, our observations and conclusions differ from what we hear in the media. We see grounds for optimism. Economic growth remains synchronised globally. Most forecasts expect this to continue, not at the same fast pace compared to the tail end of 2017, but still growing nicely. Worries about slowing growth, trade wars and real wars are part of complex and shifting human values. In the meantime, businesses are getting on with what they do best, allocating capital to create jobs and wealth.
The path for each economy is, of course, very different. For example, we highlighted the plight of Argentina and its poor economic trajectory last week. The future path for them will be extremely rocky for a period, but hopefully without any major spillover effects.
This week, we want to focus our attention on UK data readings and readings for the US, because, as the saying goes, if America sneezes, the world catches a cold.
We start with monetary policy. In the US, the Federal Reserve Bank is reversing its quantitative easing program. Until very recently, the Fed lowered interest rates to historically low levels. This is now changing, with the direction of travel being up, not down. At the same time, the central bank is no longer injecting money into the economy through QE. Both monetary tools have helped stimulate economic recovery from the depths of the global credit crisis. The signal from the Fed is that these tools are no longer necessary.
For some time, the Fed has been increasing interest rates gradually and reducing the amount of bonds repurchased each month. At the same time, they are taking lots of different factors into account to help judge what is the right future course to avoid derailing economic improvements already underway. The aim of the Federal Open Market Committee is to maintain stability by controlling the inflation rate at somewhere around the 2% level. They also want to ensure healthy and robust growth. It's worth recalling that the committee has managed to push through 6 quarter-point raises over the last 3 years without hurting the economy.
The situation in the UK is different. The Bank of England is keeping unchanged its QE programme, which pumped £435 billion into the economy. They are, for now at least, stuck with ultra-low interest rates. Remember, interest rates were cut shortly after the referendum vote to leave the UK and brought back to the same level of 0.5% a year later.
It isn't easy for the bank's Monetary Policy Committee to raise rates at this juncture. They are in a trickier spot than the US, which has a much larger economy that is at a more advanced part in the cycle. Although the economy is lagging as the cycle matures, we're getting positive signals in certain areas. The jobs market is healthy, with wages picking up, and signs that businesses are confident enough to start investing. We also have a clear signal from the bank that they're inclined to raise interest rates, but only when the time is right. They want to have flexibility in the years ahead to drop rates again from a higher level if and when the economy faces a downturn.
In conclusion, soft economic data and the Brexit cloud is painting a different landscape for the UK versus the US. Both economies are at different stages of their recovery from the global credit crisis and the way they are rolling back emergency measures to stimulate growth. This leaves the Monetary Policy Committee in wait-and-see mode.
Thanks for watching. Don't forget to subscribe to the True Potential Investor YouTube channel for more of our videos.